the channel where we talk about personal finance, setting goals, achieving goals, taking responsibility for our personal finance by increasing our financial IQ and educating our children so we can break the cycle of generational poverty. New video guide. This is a continuation of our series in terms of our monthly dividend from our M1 portfolio. We have done November through April, November of 2019 through April of 2020, and now this one is going to be May, the dividend for May. Before we get into the video, guys, just remember to let people know, friends, family, colleagues, whoever it is, that there's a place to go where people who are not CPAs or financial advisors or doesn't have an MBA, but they are taking responsibility to educate themselves, and they are taking it seriously to make passive income. Because as you see, the situation we're in right now is that you cannot really put all your eggs in one basket. You can't really depend on your job. So let's get into it, guys. So we got 15 payments from 15 companies in May. And as you see here, our first payment here came on May 1st from AT&T, ticker symbol T. They paid us $81.93. That's the largest payment we got in May. Everybody knows about AT&T, right? Ma Bell, they have cell phone services. I think they merged with Time Warner. So it's a big company. So let's go into our Seeking Alpha website, which we talked about last week, ticker symbol T. So let's go to Seeking Alpha and we'll get a little basic information about AT&T. So ticker symbol is T, AT&T. This is what the trading price is right now, or what it closed at last time the market closed, $30.26. Over here, you have some basic demographics here. 52-week low, about $26. 52-week high, about $39. The dividend rate it pays for the year is about $2.08. That's for the year. And it pays it quarterly, so you're going to divide that by 4 to see what you pay every quarter. It's a $219 billion company. Big company. Let's go over here under the dividends. So AT&T paid 52 cents, and it paid it quarterly, right? Right over here, it paid it quarterly. So 52 cents times 4 gives you $2.08, and you take that and you divide that by the share price, and you get the dividend yield. It's a pretty good dividend yield, right? 6.76%. Considering that the S&P 500 dividend yield is about 2%. So 6.76%. And the payout ratio we talked about last time was when the company has earnings, 64% of the earnings goes back to the shareholders as dividends. And it keeps the remainder. So I guess that'll be about 35% to, research, development, grow the company, and so on and so forth. So that was our first check. So let's go back to M1. Our second check came from, on the same day, May 1st, Verizon Communications, which is a competitor of AT&T. They're both in the telecom space. Ticker symbol VZ, and they paid us $6.67. So let's go look at Verizon and see what we can learn about it. That's a new holding for me. I've had AT&T for a while, but Verizon is new. So Verizon, here it is here. So ticker symbol VZ, Verizon Communications. This is what it ended up, that's where it ended trading on the last trading day, $56.65. It's about in the middle of the 52-week range, right? Low of like $48, high of about $62. The rate they paid about $2.46, and that's paid out quarterly. I mean, that's for the year, so you divide by 4. Dividend yield about 4.3%, and it's a $235 billion market cap. Let's go on to the dividends. So Verizon paid about 61.5 cents. It pays it quarterly, and you divide that by the share price, and you get a dividend yield of about 4.3%. Payout ratio, it's a little lower payout ratio. AT&T was paying about 65%, and they're paying a little over half. So definitely have room to grow that dividend. Good pickup on my part to add that portfolio. Good to have that. Let's go back to, so that was May 1st. We got paid on May 6th from Lowe's. Lowe's is a home improvement store, home retailer, competitor of Home Depot. They paid $1.88. Small position I have. Low. Definitely looking to grow it. But small position on the left. So that's a LOW. Let's look at Lowe's. Lowe's is ticker symbol LOW. It's trading about $135 per share. It's at the pretty at the 52-week high. I'm looking at it now. $60 was a 52-week low, and the 52-week high is about $136.65. So pretty much close to the high. So when stocks get close to the 52-week high, a lot of time you want to kind of not buy them, right? Because you're paying more to get them, right? You gotta wait till they drop. So low at this price now, might consider maybe stop buying until the price drops. Okay, so it's about $100 billion market cap company. Let's go to the dividends. So they're paying about 55 cents a quarter. Right down my picture here. Quarter. Yeah, it's about 55 cents a quarter. I'm not sure. You heard it. It's about 55 cents per quarter. And it's 4 times a year, so you can get out your $2.20. You divide it by the share price. Dividend yield is 1.67%. So the dividend yield is not that great, all because the share price went up. And the payout ratio, only about a third, 33%. So that may have room to grow that dividend. Okay? Room to grow that dividend. Now, let me add this. You see how let me go back a little. We had AT&T and Verizon. That's diversification, right? Because they're both in the same sector of the economy. They're both telecommunications sector, right? Why not have one versus the other? Yeah, you could, but what if something happens with the one that you have, right? You say you pick AT&T, and then something happens with that, and they cut your dividend or whatever. You're kind of in a bad situation. But by me having both of the giants in the space, I'm diversified. If one goes down, I have the other one. So that's what you call sector diversification, right? It's like, for example, you'll have like BP, ExxonMobil, Chevron. That's a sector diversification. You're not putting all your eggs in ExxonMobil. So that's what you call sector diversification. Just like I have Lowe's and I have a Home Depot. May 8th, Clorox paid me. Ticker symbol CLX. They paid me $2.48. Go look at Clorox. Ticker symbol CLX. Okay, here we go. Clorox. Correction. That Colgate Palmolive Sometimes it's hard to, let's go back here. CLX. That's Clorox. So trade for about $212. Ticker symbol CLX. It's also at the high, 52-week high, right? 52-week low, $144. 52-week high, $214. It's very close to the high. Why do you think that is? The pandemic. Everybody buying Clorox, bleach, wipes. They're wiping out everything. Every time I go to work, I get the Clorox wipes. I'm wiping out the keyboard. At the computer, I'm wiping out my stethoscope. I'm wiping out everything. So, of course, the price doesn't go up. They are paying $4.44 for the year. The $26 billion company. That's pretty small. Clorox is pretty small. Let's look at the dividend. So Clorox, they're paying $1.11, and they pay this quarterly. So $1.11 quarterly times 4, you get the annual payout of $4.44. You take that and you divide that by the total share price, you get a dividend yield of about 2%. Their payout ratio, they pay about 64% out of dividends, and that's good. So they make other stuff too, but the big thing is for them is Clorox bleach. I think they make. They also own this. They bought this, the Burt's Bees, this new lip balm stuff. They have a couple other stuff. They have Glad bags, the trash bags, but stable company. It's not a great. The yield is not super great, but it's stable. Whether the economy is doing bad or good, it's going to be rock solid. You're not going to really, you're not really at risk of them cutting the dividend. So, a small position in that, and I was paid out $2.48. May 14th, I got paid from Apple. Total of about $1.66. Everybody knows about Apple, right? So let's go look at Apple. Ticker symbol AAPL, one of the biggest company out there. AAPL, Apple. Trading at $351.59 for one share. They have went up tremendously. Probably a bad time to buy it, honestly. Ticker symbol AAPL. And you can see here the 52-week range. The low is 192. The high is 355. So it's trading at its highs, at the 52-week high. So probably not a great time to be buying it. Probably going to be great to wait for a pullback. Because, you're getting less for your money. The dividend rate is paid total about $3.28 for a year. So you divide it by 4 to see what you get paid every quarter. It's a big market cap, 1.53 trillion. You normally don't see T, but usually you see B, billion. $1.53 trillion company. Let's look at the dividends. So Apple, for a long time, did not pay a dividend. They had billions and billions of dollars just, off. Probably in the Grand Cayman or wherever they had it, but it was definitely not in the U.S. And then because of the Tax Cut Jobs Act, they were able to bring it back and not getting penalized. So anyhow, 82 cents a quarter times 4 quarters for the year is $3.28. You take $3.28 divided over the share price, which is going up tremendously. You get a yield of less than 1%. So not a great yield. And look at the payout ratio. Out of all the earnings that Apple gets, it's paying about a quarter of that as a dividend. So it has room to raise and grow that dividend, right? It has room to grow that dividend. Let's see here. And you see the 5-year growth rate. I haven't talked about that, but let me mention that. Basically, what this is they take the average rate of growth, the average dividends over the last 5 years, and they basically get an average. So the average growth over the last 5 years of the dividend for Apple is about 10.5%, which means by the rule of 72, you take 72 divided by 10, you get about 7. So if Apple continues this in about 7 years, this dividend will double. Okay, that's something we're gonna look at when we do research in companies, the dividend growth rate, right? Because two companies might be equal, but if one is growing a dividend faster, you might want to take this one. Anyhow, let's go back to the M1 Finance. We got the next day, May 15th, we got paid by Abbvie. Ticker symbol ABBV. They paid us $15.09. Abbvie is a spin-off of Abbott Labs. It's in the pharmaceutical space. And they paid us $15.09. Great to have that. They are raising their dividends aggressively. Let's go look at Abbvie. ABBV. Right on the Apple. ABBV. Right on the Apple. How ironic. Abbvie. Ticker symbol ABBV. Trading $95.74. This is the maker of Humira, the big drug, I think, for like rheumatoid arthritis. Among other things, other indications. So the 52 range, anywhere from $62 at the low up to $99. So it's trading pretty close to its highs. The dividend rate, about $4.72 for the year. So you have to divide it by 4 to see what it pays quarterly. The yield is almost 5%. So it's a pretty good yielder. Almost 5%. The market cap is about $169 billion company. Let's look at the dividends. Again, $1.18. Abbvie's paying. It's a pretty nice dividend, $1.18. Pays it per quarter. You take that times 4, you get $4.72 for the year. Divided by that, a yield of 4.91%, almost 5%. The payout ratio, less than 50%. See that? That means it has room to grow that dividend. That's what you want, right? Room to grow that dividend, less than half. Look at the 5-year growth rate. The 5-year growth rate for Abbvie is over 20%. That's unheard. That's ridiculous. You compare it to something like, say, AT&T, where the growth rate is probably pretty low. AT&T doesn't really grow that much. 20.86% dividend growth. By the rule of 72, if you were to take 72 divided by 20, it's going to be about a little over 3. You're saying about 3 years or more, this dividend will double. A lot of people love Abbvie for that fact. Okay, definitely want to grow my position in Abbvie. So just remember this 5-year growth rate, 20%. Does it compare it? Let's look at AT&T just for you to see what I'm talking about. Let's go back to AT&T, ticker symbol T, and you compare the 5-year growth rate. Ticker symbol T. Where are you? There you are, right here. So Abbvie 5-year growth rate we said was about 20%. AT&T. Let's look at the 5-year growth rate for AT&T. AT&T is a high yielder, right? It's like over 6%, almost 7%. But it doesn't grow the dividend that much. So, you're going to have a mix of these companies in your portfolio. You'll have some that are high yielders. AT&T, dividend investors, they love it. It's a high yielder, right? Over 6%. But it's not going to grow the dividend that much. Right now, 52 cents. Last year, it was 51 cents. They raised it by 1 penny. Come on, inflation alone, it probably eat this up, right? Compared to Abbvie, which we just looked at, right? Ticker symbol ABBV, and a 5-year growth rate, we said was over 20%. That means it is really growing. I mean, you're going to be way above inflation. You want to maximize your share count in that company. Let's go back to the M1. The next, actually the same day, May 15th. So May 15th, we got a couple of checks. We got a lot of checks on May 15th. So Abbvie. Next one was Colgate Palmolive. Colgate Palmolive paid us $2.47. They're in the consumer staple sector of the economy. So you think of Colgate toothpaste, Palmolive soap. stuff that you're going to really need, whether the economy is up or bad. You still got to brush your teeth, still got to wash your dishes, and so on. So let's go to take a look at Colgate Palmolive, ticker symbol CL. Ticker symbol CL, Colgate Palmolive, $73 a share. We're trading, and the quick blip here. It's close to the highs. 52-week high, 52-week low, $58. 50-week, 2-week high, about $77. So it's close to the highs. It paid about $1.76. So I would think you divide it by 4. The yield is about 2.44%. It's a $62 billion company. Let's look at the dividends. So just guessing, would you think a company like Colgate, Colgate Palmolive, old companies, kind of stodgy, is going to be high, will grow their dividend high or low? Probably low, right? That would be my guess. Let's take a look. It paid 44 cents a quarter, right? We said at 44 cents a quarter. As you can see over here, times 4, we had $1.76 for the year. Divide that by the share price of $73. You get a yield of about 2.4%. Payout ratio about 60%. So they have room to grow its dividend. But it doesn't grow that high. It doesn't grow that fast. Only about 3.79%. But it'll keep up with inflation. It will keep up with inflation. Let us go back to the M1 Finance. The same day, May 15th, Costco paid us. Everybody knows about Costco, right? You go in there and you get your big can of tuna fish. You get your jumbo eggs, 48 eggs, all that stuff. You pay the membership. Costco, ticker symbol COST, paid me 46 cents. We're not going to retire in that one. 46 cents. So let's go and look at Costco's. Ticker symbol COST. Here is Costco's. Ticker symbol COST. Trading at about almost $300 a share. Let's look over here at the little 52-week low, about $260. 52-week high, about $325. So close to the highs. The dividend rate, they paid about $2.80 for the year. So you divide by 4. See what they paid quarterly. And the yield is less than 1%. Market cap, $133 billion company. Let's go to the dividends. So we said Costco paid about 70 cents per quarter times 4. So it's going to be $2.80 for the year. Divided by the share price, you get a dividend yield less than 1%. Not great at all. Less than 1%. But the positive it has is that here and here, the payout ratio is very low, only 33%. So there's room to grow that dividend, right? There's room to grow that dividend. When you see a company paying, like for example, I think the last video we did, Iron Mountain, ticker symbol IRM, they were paying actually over 100% payout ratio. And you say, how could that be? I would say, well, the same way that you could spend more than you make by debt, swapping the credit card. Companies can also take out debt too. So that's not good and it's not sustainable. You can maintain it in your lifestyle, spending more than you make, and a company also can't do it. So that's very something concerning you have to look at when you see them paying payout ratio greater than 100%. When you see something like this, 33%, you know that they have room in which they can raise that dividend, which is great for a dividend investor. And the other thing that is also very encouraging is the 5-year growth rate. The 5-year growth rate for Costco is 14.5%. Also excellent. That means that they continue this by the rule of 72. 72 divided by about 15. Probably in about, 4 years or so? 4 or 5 years, this dividend will double. That's great. So payout ratio is important. The 5-year growth rate is important. Because remember, the yield is a ratio. It's the dividend payout over the share price. So if it's a ratio. So the share price goes up, right? Share price goes up. That means the dividend yield goes down. If the share price drops, the dividend yield go up. So typically you see a company with a high dividend yield, 8, 9, 10%. Oh, great, let me go invest in that. Be careful. It's called a yield trap. It's called a yield trap because the dividend yield could be high because the share price is dropping. Why is the share price dropping? The share price could be dropping because there's something fundamentally wrong with the company. Perfect example. The cruise line, Carnival Cruise Line, the dividend yield just skyrocketed because they were trading about $50 and the share price dropped during all the virus talk. Dropped down to, I think, to a low of $8, right? So if the dividend payout was the same and the share price was dropping, guess what? The dividend yield went up. So instead of running in, to buy it, you have to be cognizant, be aware that the reason why the dividend yield is high is because share price is dropping because there's something fundamentally going on, right? And it's stuff that was going on is that they're canceling travel, right? No income, and then eventually what happened is they suspended their dividend. So you have to look out for that. It's called a yield trap. Let us go back to the M1 Finance. The same day, on May 15th, we got paid by NNN, National Retail Properties. National Retail Properties is similar to our Realty Income, which you're going to see out here. It is a REIT, a real estate investing trust, and they lease out properties to our retailers, and they collect rent. The company that they lease it out to take care of the maintenance, the taxes, the insurance, everything, and they collect the check. So it's a new addition to the portfolio. Glad to have them. They paid me $10.24. Let's take a look at National Retail Properties. It's my first dividend from them. And let's take a look at them. Here you are, right here. National Retail Property, ticker symbol NNN. They traded about $36.89. They are in the lowest portion of their 52 range. The 52 range was about $24. The 52-week high was about $59. And obviously, because they're a real estate investment trust, and there's not a lot of real estate going on, right? So the stores that's renting from them, their tenants, probably not getting a lot of traffic because of the stay-at-home order and so on. So not surprising that they're at the lower side of their 52-week range. Let's look at the dividend rate. They get paid $2.06 for the year, so obviously you divide it by 4. The market cap is a very small company, only $6 billion market cap. Let's look at the dividends. So National Retail Property paid about 51.5 cents per quarter. It's paid quarterly, 51.5 cents quarterly, and for the year it'll be $2.06. You divide that by the share price, and you get a dividend yield of over 5%, 5.5%. The payout ratio is about 75%. Typical in these REITs, real estate investment trusts, you'll see a higher payout ratio. So that's okay. I'm okay with that 75%. And the growth rate is about 4%. So good to have that in the portfolio. Let's go back to M1. Our next payment was also a new addition to the portfolio. PBCT, People's United Financial. It's a bank. I guess it's like a regional bank, mainly in the I guess we'd say New England area, Connecticut. I think the headquarters might be in Connecticut, Massachusetts. I think there's maybe some in New York too. They paid me $7.93. Let's go look at PBCT. It's a new addition to the portfolio. Here we are, PBCT. It is the People's United Financial. They traded about $12.07. The 52-week range, low was about $9.37, high was about $17. So somewhere in the lower half. The dividend rate is about 72 cents for the year. So you divide it by 4. The yield is about 5.7%. It's a small bank, $5 billion company, $5 billion company. Let's look at the dividends. So People's United, it's paying me about 18 cents per share, and it's paying it quarterly. And for the year, you get 72 cents for the year. Divided by the price of the share, $12, you get a yield of about 5.72%. The payout ratio is about 66%. Not bad, not bad. It doesn't grow its dividend that aggressively, but you're already getting a high starting dividend. So what you're going to see normally is that either companies with high starting yield, they usually don't grow that aggressively. And companies with low starting yield, sometimes they'll grow aggressively. And then you'll get a mix. A company like, what the best of both worlds is when they have a high starting dividend and they grow aggressively. A company like Abbvie, they're about over 5% starting yield and aggressive, and they have a 5-year compounded annual growth rate of over 20%. So that's the best of both worlds. So great to have this to the portfolio. Over 5% yield. This is awesome. But like I said, the growth rate is not that great. Like I said, this is like probably under less than inflation, but you're having a good starting yield, so it kind of pays off. Okay, let's go back to the M1. We got paid on May 15th by Realty Income, the monthly dividend payer. We've spoken about that before, but let's go take a look at Realty Income, ticker symbol O. It is the monthly payer, and every month you get paid. It's great to have a company like that. I'm telling you. Everything else we're talking about is quarterly, but it's good to have that company every month. You're gonna get that check every month. That's great to have that. Realty Income, ticker symbol O. Sharing about $63.06. The 52-week range about $38 in the low, $84 in the high. The dividend rate, you get about $2.80 for the year. You divide it by 4. The yield is about 4.4%. $21 billion company. Let's go to the dividends. So it's a monthly payer. So Realty Income pays about 23 cents per share, and it pays that monthly, right? Not a lot of monthly dividend payers that are out there, but there are a few. A lot of them are in the REIT category, which makes sense because they collect rents, which are monthly, and then they can therefore pay out their investors because they get monthly payment. So 23 cents per share, and you get paid monthly. So you take this and you divide it by 12, or you multiply by 12. You multiply by 12, and then you get $2.80 for the year. And you take that, you divide it by the share price of $63.06, and your dividend yield of about 4.4%. Not bad. Payout ratio, again, it pays on a pretty high payout ratio, but we said REITs typically pay out a high portion to their investors. As a matter of fact, by law, they are mandated by law to pay out most of their earnings to the shareholder. That's how they get the special tax treatment by the IRS. 5-year growth rate, 4%, so it's above the inflation rate. So let's go back to the portfolio. We got paid on May 20th from Caterpillar, the big industrial company. You see all their big yellow road builders, cranes, heavy equipment, whenever there's any construction going on. They paid me $2.97. Let's go and take a look at Caterpillar. Ticker symbol CAT. And it is in the industrial space, industrial sector. Trading at $128. Ticker symbol CAT. The 52-week range is $87 for the low, $150 for the high. The dividend rate, you get paid about $4.12, so you divide that by 4 because the quarterly payment. The yield is about 3%. It's a $70 billion company. Let's look at the dividends. So Caterpillar's paid about $1.03 per quarter, right? $1.03 per quarter. Yep. For the year, you get about $4.12. You divide it by the share price, and you get a yield of about 3.1%. Payout ratio is paid about 83% out of in dividends. So it's a little on the high side, right? You begin to get a little concerned. Will they be able to maintain the dividend when they're paying so much out there? The growth rate is about 7%. That's above inflation, which is great. So let us go back to the portfolio. Our next payment was on May 22nd. We got paid from Starbucks. Ticker symbol SBUX. And we got paid two checks, $6.27 and $2.40. So that's probably about $8.70 something. So over $8 from Starbucks. We all know about Starbucks, right? Obviously because of the virus and everything going on, there's no sit and dine. So just the drive-through is open. But people of Starbucks, they have a very loyal customer base. They line up to pay their $5 for their Frappuccino, their Cappuccino, and as soon as things get back to normal, people are going to be rushing into Starbucks. They go there morning, they go there at night, they go there all the time. Let's look at Starbucks. Ticker symbol SBUX. Starbucks. Ticker symbol SBUX, trading about $77.10 at the 52-week range. The low was $50. That's at the start of the pandemic. Now the high was about $99. So they're kind of somewhere in the middle. It's a good place to buy, actually. A very good place to buy. You have an opportunity to buy. The dividend rate, you got $1.64 for the year. They divide it by 4. The yield is about 2%. It's about a $90 billion company. Let's take a look at Starbucks dividends. So Starbucks is paying 41 cents, and it pays this out on a quarterly basis. You take 41 cents divided by times by 4, and you get about $1.64 for the year. And you take that and you divide it by the share price, and you get a yield of about a little over 2%, 2.1%. Now, look at the payout ratio. The payout ratio is ridiculous, right? Before all this madness with the viruses going on, the payout ratio was a lot less. I think this is going on because their earnings have dropped. But we think this is going to be temporary. Their earnings have dropped. That's why the payout ratio is so crazy, right? Over 100%, it's crazy. Look at the people love Starbucks because they grow their dividend very aggressively. 22%. This is even higher than Abbvie's growth rate. So they're growing their dividend very aggressively. What the pandemic is going to do, and what effect the pandemic is going to have on that, time will tell. But that's why the payout ratio is so crazy, because the earnings have kind of took a hit. They had to close stores in China and all over the place. But they're going to bounce back. Absolutely, they're going to bounce back. I will be holding that. Let's go back to M1. On May 28th, we got paid 2 checks. Actually, 1 check on May 28th. SJR, Shaw Communications, ticker symbol SJR. It's a monthly payer as well. $3.52. And this is a Canadian telecommunications company. Let's go to SJR. Canadian telecommunications company. Let's go to SJR. Here we are. So it's like the Canadian AT&T, right? So SJR, Shaw Communication, SJR, the ticker symbol, Shaw Communication. It's trading about $16.77. The 52-week range, the low is about $12, high is about $20. So it's like in the middle. The dividend rate is about 87 cents, and they pay that monthly, so you have to divide it by 12. The yield is pretty good, 5.1%. It's an $8 billion company. Let's go to the dividends. So Shaw Communications pays monthly. which is great to have in a portfolio monthly. So every month, getting a check. Just like realty income. Every month, getting a check. Great to have that. So they pay about 7 cents per month per share, right? And you take 7 cents times 12, you get 87 cents for the year. You take that 87 cents divided by the share price of $16.77, you get a yield of 5.15%. Payout ratio is pretty high, 94%. Their 5-year growth rate is negative, which means maybe the rate of growth is kind of slowing down. But the bottom line is, I love the monthly payer. I love the fact that the yield is high, it's over 5%, and I'm going to hold it for now. Let's go back to the M1 portfolio. This rate is basically mean that I told you before. I have a portfolio loan against my portfolio, and the payment, they kind of sell those shares. So they sold 53 cents of Shaw Communication. The last check for the month was from LTC, another monthly payer. So I have a couple of monthly payers mixed in with the quarterly payers. LTC, long-term care, paid me $2.91. We said that's in the medical space, senior housing, assisted living facility. Let's go look at LTC. LTC. Ticker symbol LTC Properties is trading about $38.96 to 52-week range, $24 for the low, 53-week for the high. So it's kind of in a good place to buy right now. The dividend rate is about $2.28 for the year. Obviously, it's a monthly pay, so you divide it by 12. The yield is over 5%, 5.73%. It's a small company, only $1.5 billion market cap. Let's look at the dividends for LTC. So they're paying 19 cents, and this is paid monthly. So you take 19 cents times 12, you get $2.28 for the year. Take $2.28 divided by the share price, you get a dividend yield of 5.73%, which is great. The payout ratio, 77%. Not bad because it's a REIT. And the growth rate is about 2.2%. So that'll probably keep up with inflation. But it's okay because you're given a great starting yield. Okay? If you get a great starting yield, even if it doesn't grow that much, you're okay. You only have a problem with when it's a low starting yield and it's not growing. Like, why do I need you? If it's a low yield, low starting yield, and it's growing, you'll stay because, in a couple of years, you're going to get up to where you want to get to. Let's get back to the portfolio. So that was the last payment. So here it is, May 2020, 15 checks, total of $153.21. $153.21 that I did not have to work for. $153.21 that came to me while I was sleeping. $153.21 that let me know I'm on the right direction. I look back now, even 6 months ago, right? They were getting pennies, right? And now you look in the dividend check now, and there's nothing under $1, right? Well, Costco's 46 cents. That's the only one that's under $1 because it's kind of new to the portfolio. But you can see, except for that, everything else is over $1, right? So you go from pennies to dollars, and then from dollars to tens of dollars, from tens of dollars to hundreds of dollars, to thousands of dollars, to 10,000 of dollars. But you have to start somewhere. You have to be consistent, and you got to be serious, right? You can spend your money on a lot of things, but a lot of things you spend your money on will be there'll be nothing coming back. There will be no return. But you spend your money in dividend stocks, and even though we know dividends are not guaranteed, right? Because the board of directors can suspend it depending what's going on. But you spend your money on dividend stocks, solid blue chip companies, you will get a return on your investment. And it's great to have passive cash flow that you don't have to work for, and dividend raises that you're not even asking for, that'll allow your income to keep up and even exceed inflation. So guys, this is the dividend, this is the MD investor, right? Talking about dividends. Let your friends, family, colleagues know that there's a place to go to where real people without, financial, formal financial education, no MBA, no CPA, no CFP, but we're studying and we're learning. We realize that people have been taking advantage of us, and now it's time for us to start doing for ourselves. We see the big gap in the investment involvement between African Americans and whites. It's a gap, and the gap is there, and the way to narrow the gap is to start getting yourself educated, and that's why I'm showing this to show that I'm not a financial expert, but I am studying, and by studying I get confidence, and by getting confidence, I take action, and when I see positive results like this, that makes me what do you call it? Positive reinforcement, positive results. Keep doing it. Get more results. Keep doing it, and that's how in 6 months you go from 12 cents, $1 to now over $150 in passive cash flow. What's the next 6 months going to be? Right? It's exciting to anticipate the positive results that you're going to do, because basically you're changing where you're putting your money, right? You can put your money in a lot of stuff, but there's no payback. You put your money here, it's going to grow that snowball for you. So we're going to leave it there, and we're going to say continue to take action, study, learn, and to command your money to grow. And I will see you on the next one.